Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with the Bank of New Zealand. Remember this day, September the 30th, double downgrade day. Both Fitch and Standard & Poor's have cut New Zealand's sovereign credit rating to AA from AA+. This is the first time in 13 years that New Zealand's credit rating has been downgraded. Both agencies are concerned about New Zealand's net foreign debt, and in particular, the way the government's accounts are running. They both say they're worried about a widening current account deficit and very high budget deficits. They're concerned the New Zealand economy is not adjusting and pulling in its high spending habits. New Zealand remains still dependent on foreign debt to essentially spend more than it earns, and it's also dependent on volatile commodity prices. After this announcement, the New Zealand dollar fell from 78.2 US cents to 76.5 cents and also fell against the Australian dollar. Wholesale interest rates rose between 3 and 10 basis points. The longer-term outlook for what this means for interest rates and for the exchange rate is less clear. Interestingly, in the United States, when Standard & Poor's downgraded the government there, yields actually fell quite sharply. You could say the US dollar and US Treasury market's slightly different to ours, but certainly credit rating agencies aren't necessarily driving what's happening in credit markets at the moment. Also, the New Zealand government held a bond auction yesterday where it sold a record $1 billion worth of bonds at very low yields. That's because we're the least ugly of all the countries. We win the ugly competition for being the least ugly. However, this is a wake-up call for politicians and for voters. New Zealand, quite plainly, can't continue spending more than we earn. At the moment, we can only make that gap match by borrowing money offshore and by selling our assets. Now, the government has dismissed the ratings cuts today. Bill English said the ratings agency had essentially shifted the goalposts because international investors were more concerned about foreign debt and about net foreign debt. He also doesn't accept that New Zealand will return to a pattern of high household spending driving current account deficit. He says that the current account deficit and the GDP growth rate should remain about the same, which will be okay. But I have to query Bill English there, because when he says that New Zealand's current account deficit is likely to be in line with our GDP growth, well, that's not according to his own budget forecasts, which say that our current account deficit is likely to blow out to between 5 and 7% over the next couple of years. And also, it's not necessarily a current account deficit driven by household spending this time around. It may largely be because of foreign profits that are being repatriated and also interest on foreign debt. There's a real structural problem here. Now, Prime Minister John Key says the ratings agencies are not so worried about the government, they're worried about private sector debt. And that's why Standard & Poor's and Fitch have downgraded New Zealand. Well, you have to wonder about that because the credit rating agencies actually downgraded the government debt and spoke mostly about the government's budget position and how government dissaving, i.e. running deficits, was responsible for a current account deficit, and that the fastest way to reduce that current account deficit was for the government itself to get closer into surpluses. Now, the government's still confident it can get back to surpluses by 2014-15, but it's going to need quite a bit of luck on the economic growth front, particularly overseas, and that's something the credit rating agencies are nervous about. Now, what does this mean for interest rates and house prices? Well, interest rates you would expect after this downgrade to be slightly higher than would otherwise have been the case. Now, that may not mean they're about to rise anytime soon, but if we continue to see these higher funding costs internationally because of the financial market volatility, that could be a factor. That means the banks actually increase mortgage rates even though the official cash rate has been left unchanged. Now, we're still a wee way away from that yet, but it's a worry on the horizon, and the government itself has warned that a credit rating downgrade could cost the government itself up to $1 billion in extra interest costs. So there we have it. A real day in New Zealand's economic history, September the 30th, double downgrade day, and one we should remember for some time to come because it's telling us that we can't continue to spend more than we earn on our current track. I'm Bernard Hickey. That's a special economic weather report brought to you in association with the Bank of New Zealand.